Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Welcome. So, you're a Canadian business owner and you've got your sights set on going global. You're in exactly the right place. Today, we're going to deconstruct the essential tax considerations you'll face when expanding into foreign markets. This is such a critical piece of the puzzle because, at the end of the day, a smart tax strategy is the key to successfully bringing your hard-earned profits back home.
Look, the prospect of international expansion is thrilling, no doubt about it. But the moment you cross a border, you're introducing a whole new layer of complexity. This is especially true when it comes to taxation, which can seriously eat into your profitability if it isn't managed strategically right from day one.
Okay, so where do we even begin? Let's lay out a roadmap. We'll start with the single biggest tax challenge every international business faces. Then, we'll explore your options for structuring your foreign operations. From there, we'll dig into the 3 core tax questions you absolutely must answer, get into the weeds on cross-border transactions, and then wrap it all up with your strategic next steps.
All right, let's jump right in. The Global Tax Challenge. This is the foundational concept, the starting point for all of your international tax planning. So here's the core problem, the main issue we have to solve. Imagine your Canadian business earns a profit in, let's say, Germany. Well, Germany is going to want its cut. They will tax that profit. But hold on, you're a Canadian company, which means the CRA back home also views that as your income. They want to tax that very same profit. And that's the dilemma, the risk of being taxed twice on the same dollar. This problem of double taxation leads us directly to a foundational decision, one that will shape your entire tax strategy. How are you going to physically and legally structure your presence in that new market?
Fundamentally, you have 2 paths. First, you can simply conduct business from your home base in Canada. Think direct exporting. It's the simpler route for sure, with lower initial complexity. The second path is to go all in and establish a formal physical presence abroad. Now, this is where things get a lot more complex, operationally and from a tax perspective. Now, what you're seeing here is a great visualization of the 3 primary structures you can use when you decide to establish that formal foreign presence. Let's break these down. Direct sales is, well, direct. But if you want a physical presence, you've got 2 main choices, a foreign branch or foreign corporation. Now, think of a foreign branch like building an extension onto your Canadian house. It's legally still part of the same structure. The big upside here is if you have early-stage losses, which is common, you can often deduct those losses against your Canadian income. That's a huge benefit. A foreign corporation, on the other hand, is like building a completely separate house next door. It's a distinct legal entity. This is fantastic for liability. It shields your Canadian house from problems, but moving money between the 2 houses gets more complicated.
Okay, so regardless of which of those structures you're leaning toward, your analysis has to answer 3 critical interconnected questions. This is your strategic checklist. First things first, you have to play by their rules. What are the corporate tax rates in your target country? What expenses can you deduct? What activities actually create a taxable presence there? You have to establish this baseline. Second, you have to look at it from back home. How and when will Canada tax those foreign profits? And here's a big one. What happens if you have losses? As we just discussed, the ability to use foreign startup losses to offset Canadian profits is a powerful advantage that depends entirely on the structure you choose. And finally, we have to look at the money that moves between your Canadian headquarters and your foreign operation. This isn't just about the final profit at the end of the year. It's about every single transaction that crosses the border between your related companies. And that's a perfect segue. Let's dig deeper into these transactions because you can be sure that tax authorities in both countries are watching them very, very closely. Just look at all the different ways value can be transferred. We're talking about intercompany sales, transferring assets, paying rent or royalties, bringing profits home as dividends, paying interest on loans, charging management fees from the home office, you name it. Every single one of these is a distinct event with its own tax consequences. So the crucial point here is that you have to be very deliberate about how you price these internal transactions. Tax authorities call this the arm's length principle, meaning you have to charge your foreign entity the same price you would charge a completely unrelated customer. They're making sure you aren't artificially shifting profits to a low-tax country. This whole area is known as transfer pricing, and getting it wrong can result in some major penalties. So after all that, what are your takeaways? Let's consolidate these ideas into a strategic perspective that you can actually apply to your business.
It is absolutely vital to remember that these are general principles. The actual tax laws you'll encounter will depend entirely on the specific country you're expanding into. The rules for the US are vastly different from the rules in Germany, which are different again from the rules in Japan. And this is the ultimate rulebook for managing those differences. These bilateral tax agreements, or treaties, are negotiated between Canada and other nations specifically to prevent that double taxation we talked about earlier. They provide the clear rules of the road, identifying which jurisdiction gets to tax which part of your income. And this brings us to the final strategic question you need to be asking yourself. Which structure really aligns with your long-term vision and your appetite for risk? Remember our house analogy. A foreign branch might offer those valuable initial loss deductions, but it also exposes your entire Canadian company to liabilities abroad. A foreign subsidiary, that separate house, creates a liability shield, but bringing profits home can be more complex. So you see, this isn't just a tax decision. It's a core business decision about your long-term global strategy.